If you have ever asked a husky to take off their coat and stay a while, you're probably already aware that they have no sense of humor. Maybe it's because they tend to suffer from irritable howl syndrome from all the calories they eat. You think teenagers are hungry? Oh, try feeding a team of sled dogs. Hi, Chihuahua. Those huskies can really pack it away. Most likely, however, it's probably from all the pressure of having to pull a sled containing an overweight human wrapped in 50 layers of fur up and down mountains all day. It's very competitive, you know. They all want to be at the front of the pack pulling the sled. The huskies, that is, not the human. But that place is reserved for only the fastest dogs. If they get faster, they get moved closer to the front, but if they get slower, they end up in the back. The moment they can't keep up with the pack, they get retired and replaced with a new, faster dog. Index funds work like this. They just don't eat as much, and sleds are rarely involved. An index fund owns the shares of many different stocks. So, when an investor buys a share of an index fund, they are actually buying the shares of all the stocks contained in the fund. When one of those companies stops performing, it gets replaced with the next up-and-comer. This causes certain index funds to go up and down in the short term, but up for the long term. You could say they have an upward bias over time. There are all sorts of index funds. Market-based, commodity, energy, financial, pizza. Okay, maybe not so much on the pizza, but hey, this is why the big dogs stick with index funds, and so should you. Notice, I didn't mention mutual funds. Now, why would that be? Well, it don't take no bloodhound to solve that mystery. Woof! Before you go, don't forget to hit that subscribe button, and maybe even like this video if you're so inclined. Who's a good human? You are. Woof!